Okay, so we're going to look at assorted questions. So we're going to behave like we are writing. So question 1 of the 2024 test, we're asked to identify 4 sources of short-term financing for commercial banks, of a commercial undertaking, here excluding government funding, grants, and donations, and discuss the costs associated with them. So what are any sources of financing? Anyone? Any 4 sources of short-term financing? Let us also look at long-term financing.
Treasury bills.
Okay, treasury bills, yes. Continue.
Commercial paper.
Those are for short-term, yes. And we need to explain the associated costs of each. Yes, let's participate. Okay, in the interest of time. So there are many sources of, so this is from unit 1. There are many sources of short-term and long-term financing. We have short-term financing options like the trade credit, bank overdrafts, the short-term loans, the commercial papers, and factoring. Now, trade credit basically involves what? Purchasing goods and services on account from suppliers. So sometimes you have, so trade credit meaning you're buying things on credit. So costs associated with trade credit will include payment discounts available. We also have bank overdrafts. What are bank overdrafts? It's a short-term facility which is provided by banks, and this will allow businesses to withdraw more than what they actually have, more than their limit. Of course, there are costs attached for overdraws. We also have short-term loans. Typically, these are loans that are due within a year. They are part of the short-term financing. We also have a commercial paper. Somebody explain the commercial paper. Commercial paper. So we talked about trade credit, which has usually no form of cost. We've talked about factoring, invoice discounting. I'm just expanding these points so that you should understand how to expand them. So these are sources of short-term financing. Commercial paper is basically an unsecured short-term debt instrument, which is actually issued by corporations who typically want to finance short-term liabilities. So the costs here that are included will include the interest payments, which will vary depending on the prevailing interest rates. We also have factoring. Factoring basically involves selling accounts receivable to a third party. So, okay, people were supposed to pay me. These are my debtors. So they owe me 100,000. So give me 80,000, but they'll pay at a later date. So this, the cost of this is a discount rate that is applied. Okay. So we also have long-term financing options, although they have not been asked for here. I just want to open up our minds. What are some of the long-term options that we have? Long-term options.
Debt and equity.
Yes, correct. Debt, capital, and equity. Yes. So debt and equity. Which other ones? So for long term, we have debt financing, which is in terms of common stock, involves selling ownership of shares in a company in exchange for capital. So the cost here of engaging in equity is what? Dividends. We also have debt financing, where we use bonds. These bonds are issued by corporations or governments. The cost of bonds are coupon payments. We also have long-term loans, which are issued for more than 1 year period. The cost is simply the interest. We also have preferred stock, which is similar to equity, but it has different properties. The costs are dividends as well. We also have venture capital, where we may obtain financing from investors in exchange for equity ownership in our company. So the cost is giving up a portion of our ownership, basically. So in general, we need to understand the short-term and long-term sources of financing. Are we together? Are we clear on that? So
Yes, clear.
very clear. Okay. So part B, a startup company has been set up to invest in development of new fuel sources. Identify two types of investors who would likely invest in ordinary shareholders of such a company and explain why. So somebody wants to start up a company in fuel sources. Identifying two types of investors that would be interested in two types of investors who would be unlikely to invest in ordinary shares of the company. Explain why. Okay. So we know that startup company using new technology is very risky. It needs heavy capital investment and a larger pool of funds. So there are some investors who are likely to be interested in the operations of such a business. So there are unlikely to be funds from operations to pay dividends needed if the company is concentrating on development rather than production. So the prospect of dividends being paid in the near future will probably be remote. So investors will not be attracted to invest in ordinary shares and would include those who are risk averse. Okay, so basically this question is trying to give us a scenario of the types of investors. We have different types of investors who we may categorize as risk seekers, risk averse, and risk neutral. So in a fuel business, which type of investors would not be likely interested in engaging in such kinds? So this is what the question was trying to ask us. Are we together? Are we together?
Yes, we are following.
So you can expand that. This is a very applicable question. You need to expand it in a way that the examiner will understand. So I've broken down at investment that has significant risks, like the fuel business. It also has some political risk in there. So this risk basically will encompass issues of regulation, issues of taxes, issues of profitability. So in this explanation that was given by the lecturer, I'm trying to expand it because as it is, it seems a little bit vague. Okay. So we know that fuel business has a lot of risks attached there. This technology is risky because of several factors. Investing in this it's a new development, requires huge research and development costs, as well as other costs that are related to testing, prototyping, regulations. So as a result, the company that we are talking about in question requires huge funds. Furthermore, it's in its early stages of development. So most likely or most unlikely funds who will not be paid back within the short period of time. So in fact, the company's primary focus will be on developing the product rather than generating funds from it. So consequently, this will affect the future dividends. So investors who would rather go for such an investment would be risk seekers and not risk averse. Most of the investors will be unattracted. So those who are risk averse are those who are going to require a steady flow of investment income to meet their financial obligations. Such investors basically may prefer already established companies who have a proven track record of profitability rather than taking a chance, a high risk. Of course, fuel is high rewarding, but there's high risk. So in summary, the combination of risk and lack of immediate dividends and uncertainty in this new technology will deter investors from considering venturing in this kind of setup. Okay, are we together?
Mr. Collins,
Yes, please.
would it be correct to use, say, a model like Pastel model
Yes, you can use the Pastel
to,
model
to
as
to
well.
explain this question?
Yes, 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 yes. Yeah,
Okay.
but more
Okay.
so, um, I would encourage that you also look at it from the type of investors that are in question. Okay, so let's look at another question. Okay, this was last year's paper. So corporate ownership varies around the world. Historically, individuals have owned majority of shares in public corporations in the US, in Germany, in Japan. However, banks, other huge financial institutions and other companies own most of the stock in corporations. Do you think agency problem is likely to be more or less severe in Germany and Japan than in the US in Max? Firstly, we need to understand what the agency problem is all about. Can somebody explain the agency problem? What is it all about?
I can try. So I think this could be a situation, maybe for example, where the owners of the organization have got different goals. For example, maybe their current focus is on, say, maybe wealth maximization, and then me as the manager who's managing their company is looking at things on ground, and I feel like the immediate response to whatever we're facing could be maybe investment in more equipment or things like that, some expansion of this particular item. And so there happens to be a conflict between my interest as the manager who's running the company and the owners who are also focusing on their own need at that particular time.
Excellent. Okay, so in a layman's language, we have a company that is owned by shareholders as well as managed by the board of directors. Now, agency problem usually occurs when there's a conflict of interest, when the two parties are in fiduciary responsibility. Is a principal agent relationship. So when the company decides to put a board to run the affairs of a company on their behalf, they understand that in this case, these who run in the best interests of the company. And so the principals here are the shareholders who are the owners of the company, and the agents are the managers in this case. So managers on one hand would want to maximize their gain or wealth through bonuses, also by plowing back the profits through retained earnings. Now, there are times when part of the board members are actually shareholders. You could be a shareholder who's also part of the board. And a conflict will come or arise in that instance where a dividend, you have your profits made, you have to now divide your attention. Do we plow back the money into the business? By the way, retained earnings are the cheapest way of plowing back money into the business on account that it has no cost in a way, because just plowing back other than borrowing. And on the other hand, owners of the business who are the shareholders are not always going to understand to say, we are not doing well, let us plow back. So now we have this principal-agent relationship. The problem will commonly occur where one party who's a principal will delegate decision-making authority over resources. Because, by the way, the board of directors are the ones who are now handling the finance directors. And now we also want the agent, okay? The principal also, on the other hand, wants to maximize their gain through their shareholding. So the concept of the agency problem is a persuasive problem that occurs in most businesses, in finance and governance. So there are a number of common examples that we could use to illustrate this agency problem. We can come firstly, maybe aspect of corporate governance. For instance, in a public traded company, shareholders who are the principals will delegate the decision-making authority to the management team board who are the agents. However, we know that the managers may prioritize their own interests like job security, the personal wealth, over maximizing the shareholders' wealth. So this will lead to what we call agency costs. They will become a cost on on the business. So now they need to balance up, aligning whose objective should I take care of at the moment. Me being an agent to work in the best interest of the shareholders, or in the best interest of the company, or as an individual. They also have issues to do with their fiduciary responsibilities. There's what is called fiduciary responsibility, act in the best interest of whomsoever at that particular moment. So this is where the agency problem comes in. I think I was trying to elaborate on what she was saying. Are we clear now on the actual issues? Are we together? So now the question comes, corporate ownership varies around the world. Historically, individuals have owned majority of shares in public corporations, the US, in Germany, Japan. However, banks, other large financial institutions, other companies, and most of the stock in the public corporations, do you think agency problems are likely to be more or less severe in Germany and Japan than the United States? So can we actualize from what I've just explained? Let's interact. I'm given a preamble. Quickly.
Yes, Mr. Coins, once more.
Yes.
Yeah, my view is that, of course, the issues of corporate governance are more pronounced in countries like the UK. Of course, also in the USA, in terms of the regulatory framework there, it's actually very, very strong. That's why you find things like the Sarbanes-Oxley Act all those things were enacted to try and ensure that in terms of corporate is actually reduced. So I would actually submit to say the USA is actually highly regulated in terms of how corporations are managed and directed.
Okay. Anyone else with their opinions? That's very good. Thank you so much. Submission. Okay, so the likelihood of agency problems being more or less in German, Japan, US depends on a number of factors. These include corporate structures, corporate governance practices, the cultural norms. So we can analyze the scenario, Japan and Germany. So in Germany and Japan, we have been told that banks, large financial institutions, and other companies own most of the stock in the public corporations. This concentrated ownership structure can potentially mitigate agency problems to some extent. So now with the concentrated ownership, the large shareholders will often have a stronger incentive to monitor the influence of corporate management to align to their own interests. So this will actually lead to a more effective oversight and governance. It will reduce the likelihood of agency problems. Now, to add on, the long-term relationships that exist between corporations and the major shareholders are common in these countries, and these foster trust, they foster cooperation that can further mitigate the agency problems. However, where the concentrated ownership can also lead to what we call entrenchment of management, or it may also lead to what we call controlling of shareholders. So this may potentially affect corporate strategy. When we go to the US, historically, we know that individuals have owned the majority of shares in public corporations are from the US. But in the past few decades, a large number of financial institutions, such as the mutual funds, pension funds, these ones have become dominant owners. So with this trend being backed up in history, so we can say the potential for reducing agency problems is higher in the US. So in a nutshell, what I can say is that corporate ownership structures will differ from country to country. They will differ between Japan, and the US. But the severity or the extent to which agency problems will occur may depend on a number of factors. It's not a yes or no answer. They may be beyond just ownership alone. They may include issues like the governance mechanisms, the cultural norms, and also the effectiveness of the regulations that is there. So in some countries, these things are strictly monitored. Also, the increasing dominance in institutional investors in the US may also present opportunities for a better corporate governance to exist. Although this may also pose some challenges that may relate to some conflicts in interest and coordination. So this question was not a yes or no answer. It needed some in-depth of explanation. Okay. So
Mr. Collins, I have a question.
yes.
So for these types of questions, would you advise that we approach it the same way that you've just explained it, where we first of all analyze the case study and answer it in relation to all of those many factors, as opposed to going by the book? And because really, when you look at it, it's not something that you can say, oh, this, you find it in that session. So it's almost like it's a question where the basic understanding of what the agency problems is is what now you use to try and analyze the case study itself.
Exactly.
So yeah, because I'm also looking at the max, so it's better if we approach it in that way, yeah, where we just analyze everything. Do we at the end of it then state your opinion to say, so what I think is
Yes, yes,
it
yes,
would be more or less here, or you just leave it like that?
No. You need to also give a conclusion based on your facts. So there will be no clear wrong answer depending on the facts that you're going to qualify. So one would give this opinion based on the facts to substantiate. It's like a case study in court. Yeah.
All right. Thank you.
All right. So some of you are very good with analytical questions. Others are good with quantitative questions. So depending on where your stronghold is, I would advise that you really take time to see your strengths. You may not even do any calculation in the whole paper if you're good with analyzing these concepts. Are we together? Are we moving? All right, so let's go to question number 5. Theoretically and traditionally, investors are risk averse, which is true. And this tends to encourage them to spread their risk by diversifying internationally. Indeed, research has shown that fully diversified portfolio based on international securities is less than half of the risk of a fully diversified national portfolio of shares. This reduction in risk arises from differing political, economic policies and stages of trade cycles, and different industries and resources occurring in different countries, leading to lower correlation of returns and shares of companies in different countries, and those based in the same country. In addition, natural disasters, adverse political events may be limited to certain countries or parts of the world. However, in addition to normal business and financial risk, investors trading and investing overseas face extra risks, which can be separated into political risk and foreign exchange risk. Adverse movements in exchange rates can cause losses in revenue obtained from investing overseas. They can also cause accounting losses, creating a fall in the balance sheet values of assets held abroad. An exchange rate is simply the price of one currency denominated in terms of another, and as with other prices, is determined mainly by forces of supply and demand. Question: state at least 7 factors that determine the exchange rate for a currency. Okay, so state at least 7 factors that determine the exchange rate for a currency. Okay, let's interact. What are the 7 factors that determine, at least there could be 10, okay? What are some of the factors that are used to determine exchange rate for a currency?
Yes, Mr. Kwenza, what about exports?
Okay, exports. Okay, I'm listening.
Even political will, fiscal policy.
Okay, fiscal policies.
And I can say political will in a sense that the government direction or position on foreign companies in terms of how much revenue should be banked locally or kept in the local or commercial banks, like the way the government introduced recent.
Okay.
Mr. Collins, what about interest rates?
Interest rates, yes. All those answers are correct. Just need to put them in proportion. So I also
What
wanted,
about inflation?
yes, inflation rates. interest rates, inflation rates, political stability. That's true. What else did you say?
Even the fiscal policy in terms of foreign companies, how they treat how the foreign companies, how much they should save in the local commercial banks compared to how much money they should keep in foreign accounts.
All right, okay. All those answers are correct. So at least 7. So one of them is interest rates. So we know that the higher the interest rate in a country, high interest rate in a country, what will they do? High interest rates in a country, they will attract foreign capital, but will increase demand for its currency and will cause its value to appreciate relative to other currencies. So inflation rates, inflation rates also, countries with lower inflation rates generally, they see appreciation of the value of their currency because of their purchasing power, which increases compared to other countries. The fiscal policies through economic performance. So strong economic performance, including indicators like the GDP, employment rates, productivity, these will attract foreign investment, which will eventually lead to appreciation of the currency. Political stability or political will, very good, as well as economic policies. So when there's political stability and consistent economic policies, these will enhance the confidence and will attract investment in a country. The trade balance, somebody mentioned exports. So in an instance where countries with trade surplus, that is excess exports, they experience an appreciation in the currency, whose trade deficit may see a depreciation. So when you have a deficit, there'll be a depreciation in currency. Also speculation. Speculation affects currency movements. So we know how that word of mouth is very important as people talk. Our president, being the chief marketer, has been talking about this. When Zambia was into election, that was mainly speculation. So movements of the currency in appreciation within hours or days happened because of the market speculations about the future currency movements, the confidence that they had in the short term, where the traders were to buy or sell currency based on anticipated exchange rates. Also, the central bank interventions. The Bank of Zambia, in our case, intervenes in the foreign exchange market, sometimes to influence the value of their currency. This is done by buying or selling currencies or adjusting the interest rates. Also, government debt. We inherited an indebted coffers. So higher government debt relative to GDP can lead to concerns about the country's ability to repay its debts. So this will potentially depreciate the currency. Other factors could be market sentiments and investor confidence. Remember, the president talked about the confidence that people had in our kwacha. There's positive sentiments also could lead to positive appreciation of the kwacha, whereas negative sentiments will lead to depreciation of the kwacha, like wars in Zimbabwe. Other factors could be geopolitical tensions, natural disasters, pandemics, etc. These will lead to fluctuations in the currencies or exchange rates. Are you together? So this is how the 15 marks was supposed to be done. Okay, we calculated this. We'll do this tomorrow. I'm avoiding the calculations, but we did. This question has been coming over and over. Okay, so I'm trying to show you some strategy that if you have done your research very well, you can even avoid calculations and still clear the course. Are we together? Any questions this far?
Yes.
We did ratios the other day. Any questions this far? If there are no questions, we'll end here.